So the stock market has been extremely volatile in the last couple of weeks. And guys, this is the first time that I've really been invested in the stock market and really keeping up with the stock market. And guys, in this video, I want to share with you guys my investment strategy, what I'm doing, how I'm managing my emotions during the whole volatility. And I just want to share with you guys everything in case you're struggling with seeing the market drop and the roller coaster that it's being. So guys, if you are new to this channel, my name is Susan Velez, and on this channel, we talk about making money, saving money, investing money, and taking care of our health so that we can catch up for retirement, especially if you are late to saving for retirement like me. So guys, this year is an election year. You are hearing things about the Fed cutting interest rates, and we don't know about the economy, the inflation. Everything's just going crazy. It's causing the stock market to be like a roller coaster. And if this is your first time really getting involved with the stock market like me, chances are you're looking at your portfolio a little more than you should, and you're probably having a lot of panic, emotions, stuff like anger or you got into late. And now that the stock market is dipping on a regular basis, you're seeing that the prices that you paid for are a lot lower now, and you're losing money. Even though you haven't lost money, guys, we all know that you don't lose money until you pull your money out. Regardless, when you lose money, whether it's imaginary money or not, and you're seeing the unrealized gains drop, then you are feeling some emotions. And a lot of people struggle with fear, anger, and guys, loss, regardless of whether it's real or not, does have an impact on our emotions, which can lead to a lot of issues that people don't want to deal with, like stress. So I'm going to share with you guys what to do if you're struggling emotionally. So before I tell you guys what I found online as far as how to handle the volatility of the stock market, tips that will help you avoid losing money, I want to first share with you guys what my investment strategy is now that the stock market is an uncertain time because of the interest rate cuts, the election year, and then the whole inflation and everything with the economy that's going on. Has my investment strategy changed? Am I panic selling? Am I changing my allocation in the stocks? What am I doing differently? Well, the answer is I'm not changing anything. I'm continuing to invest in the same stocks, ETFs, and index funds that I've been investing in the entire time. The only thing that I'm doing different, guys, is I am leaving some money on the sideline. That way, when my stocks, my individual stocks do take a dip, or if the stock market takes a really big dip, I'm having a little bit more money on the side that I can invest on those red days and lower my cost basis, both my ETFs and my individual stocks. Other than that, guys, for my Roth IRA and then everything else that I have in my taxable brokerage accounts, I'm just dollar cost averaging every time I get paid from Home Depot. I'm investing the same amount regardless of what the stock market's doing. If it's red, I'm investing the same amount. If it's green, I'm dollar cost averaging the same amount. The only difference is that on those red days, I'm trying to put in a little bit more money, especially if it's a bigger dip than normal and the cost basis or the price of the investment drops lower than my cost basis. Then I'm investing a little bit more, buying more at a discount than I would on a typical day when the stock market's doing really good. As far as my emergency fund, guys, and my sinking funds, I am making some changes to those because once the Fed does lower the interest rates in September, those accounts, or the high yield savings account that I have right now with Goldman Sachs, is going to take a dip in interest, meaning that my money, I won't earn as much interest if I left my money in those high yield savings account when the interest does drop. So I moved a big portion of that money into T-bills and CDs to lock in a better interest rate. That way, when the Fed does cut interest rates, my money is locked up in a vehicle that has a better interest rate than what the high yield savings account will pay. So those are the only money moves that I've made. So let's go ahead and jump to this article that I found, guys, on strategies for dealing with market volatility. So it is hard to see your entire retirement investments go up in value one day and then down the next day. It's a huge psychological thing, guys. And as we all know, we hate to lose money, whether it's imaginary or not. And that's one of the reasons that people panic sell, is because they see that their money has taken a dip and they panic sell. So let's go ahead and jump into these tips that will help you prevent you from making a bad move, an emotional move that's going to prevent you, that's going to cause you to sell at a loss. So the first thing is to invest regularly in good times and bad times. And this is also known as dollar cost averaging, guys, which is what I am continuing to do. So it says having 401k contributions deducted from your paycheck if your plan allows, or putting a set amount in your IRA each month is a good idea. Although this strategy doesn't guarantee profit or protect against loss, it's one way to take advantage of a down market because you'll have the opportunity to buy shares while prices are relatively low. So all that's saying, guys, is that when you dollar cost average and you're investing the same amount regardless of what the stock market is doing, you're buying both at the highs and the lows, and it's going to be better and easier for you psychologically because you're buying at a discount when the stock market is red, and you're also getting in when it's green. So you're not going to feel like you're always buying at the bottom, but you're not going to also feel like you're always buying at the top. So if you're struggling to put money in the stock market because it's down right now, just know that you're buying at a discount. And as long as you're investing in investments that you feel secure about, guys, and that you've done your due diligence and you know that they have a good track record, then you should feel good about buying at a discount. And if you don't feel good about buying at a discount and you're struggling about putting money in that stock because it is red, then you have to look at, did you make the right investment? Why did you buy that stock? Because if you were fine buying it at a higher price, why wouldn't you be fine buying it at a lower price? For me, guys, all my investments, I don't mind buying on a red day because I know I'm getting in at a lower price. And as long as I feel comfortable about that stock, there's no reason why I wouldn't want to buy it at a red price instead of a green price. Me, I prefer to buy my stocks when it's red because it means that when it bounces back, I'm going to see a bigger profit than if I'm always buying in the greens. Step number 2, guys, is to avoid jumping in and out of the market. So it says successful market timing is very difficult because it requires getting out at the right time and getting back in at the right time. So I've seen it when I go to Reddit, guys. I've seen people say that they bought Nvidia and they bought in at 135, and now that it's dropped to last week it was like 100, and I think it reached down in the 90s, and they sold their they sold that stock at a loss, hoping to jump in when it reached $91 or lower. So they're waiting on the sidelines to try to jump in at a better price. Well, we've all heard that saying, time in the market beats timing the market. So if you pull your money out thinking that you bought in too high and now you're going to sit on the sidelines so that you can wait for a better price, chances are you're going to be waiting forever, and because you don't know what that stock's going to do. I mean, the stock market is very hard to time. I mean, every time I make a purchase, I'm thinking that I'm buying in at a good price, especially when the market's taking a dip. I set my limit thinking that I'm going to get it at a great price. And just as I buy at that price thinking, yes, I got a great price, the stock market, that stock even dips even lower. And I'm thinking, damn, I bought in too high. So you never know what the stock market's going to do. And that's why it says that you shouldn't try to time the market. You just need to leave your money in the market and know that time is on your side. As long as you have a good 5-10 years in the stock market, then you're going to be fine, guys. And just know that even though we are older investors, guys, if you're on this channel, you're probably in your 50s, you're an older investor, maybe you're mid 40s, early 50s like me, and you don't have as much time as somebody who is 23 and just getting started investing. Just know that when you do start living off your money, you don't pull all your money out of the stock market at one time. So even if you just have a 15-year horizon that before you start using your money, just know that that money that you still have in the stock market is still going to stay in the stock market and reap the benefits or the downturns of that stock market. So you have more time in the stock market than you think you do, even if you are an older investor. So just don't try to time the market. Don't pull your money out thinking that you can get back in when the stock market recovers, because to me, guys, that's just crazy. And then number 3, guys, is to maintain a diversified portfolio. So it says by investing in a mix of mutual funds and that invest in stocks, bonds, and cash equivalents, you may lower your risk because you're not overexposed to any one type of investment. Consider allocating a portion of your investments in an international or global fund. Markets outside the U.S. Outside the U.S. often move in their own market cycles. If your plan offers them, consider investing in a target date fund, which can serve as a single diversified investment. Target date funds attempt to balance investors' needs for both returns and stability by moving from a higher percentage of growth funds to a higher percentage of income-oriented funds over time. Diversification doesn't guarantee a profit, but over time it can help reduce the effects of volatility. So if you have a really hard time of the volatility and your market, and every time you see your portfolio red, then maybe your portfolio shouldn't be all stocks. Maybe you want to consider more a diversified portfolio and have some international and bonds as well too, guys. For me, guys, since I am trying to catch up for retirement, I am 51 years old. I have everything invested in stocks in my portfolio. I don't have any bonds. I did have bonds when I first opened up my account, but I sold those bonds because I know that even though I am older, I don't have a lot saved right now. So I have to be a little bit more risk tolerant than somebody who has been saving their entire life. If you've been saving since you were in your 20s, and you have a good nest egg, then maybe you want to save some of that capital. You want to think about not having all your investments in stocks. You want to have something in bonds. That way you can protect some of that capital that you've worked so hard to save. But for me, guys, since I did start late, I am willing to take the risk and have everything invested in stocks. I can still sleep at night. The volatility doesn't affect me near as much as it might affect somebody else. So you have to do what's right for you. If you need more diversification, then consider more diversification. Anything that helps you sleep better at night, guys, because it is your money. And if you're losing sleep because you're scared that you're losing money in the stock market, then maybe it's time to take a look at what you're invested in. The next step, while it's not on this article, I wanted to share with you guys anyway, is if you are looking at your portfolio every day and you're struggling with everything that you see red, stop looking at your portfolio so much. Delete the app from your phone, guys. We don't need an app on our phone to look at our portfolio every day. The app makes it so easy to look at your portfolio. And me, I look at my portfolio more often than I should, but the red days really don't affect me that much. Although that said, guys, this is the first time that I've been invested in the stock market when it's volatile. And it's the first time that I've really actually started really learning about the stock market. I was around in 2008. I am a Gen Xer, but I wasn't invested in 2008 in the stock market because I didn't have money. But a lot of people who were invested in the stock market in 2008, they said that looking at their portfolio really had a huge effect on them. And a lot of people panic sold, but those that didn't came out better than those who did. So if you are struggling and you're looking at your portfolio every day, delete the app from your phone. You don't need the app on your phone. Even to make investments in your portfolio, whether it's your IRA or if you have a taxable brokerage account, if you want to make investments and you can set up auto pay, and if you don't set up auto pay because you don't have a fixed income and you don't know what you're going to invest in, so you have to manually make those investments, you can do it from your laptop or you can do it from your desktop. You don't need that app on your phone, so that way you're looking at it all the time and then you're feeling sick because your portfolio's red. If you see that and you can't control your emotions and you're looking at your portfolio every day, it's going to make you want to panic sell, guys. So step away from the sell button, and delete the app, because selling and buying a stock is so much easier, but holding on to that stock long term is the hard part, guys, because you gotta, if you believe in that stock and you made that purchase and you did your due diligence and you know that you invested in that stock because you believe that stock is going to do well in the long term, then you have to stop looking at that app, because like I said, buying a stock and selling a stock is so easy. The hard part is maintaining it and holding on for the long term and seeing those dips, guys. And then the next step, guys, is to stop reading the news, stop following the people on social media who are instilling doom and gloom, because we all know that the news will instill doom and gloom on their headlines, on their thumbnails to get you to click. They want you to click. They want to instill fear because fear gets the clicks, guys. So if you're panicking because you're watching the news and you're following people on social media who are instilling fear, then maybe it's time to stop watching them and start following or listening to other people. And guys, just know that these people make money when they instill fear, because we all know that fear gets the clicks. So just know that these people who are instilling fear, they want to instill fear in you because that's how they make their money. And then the next tip, guys, is to remember the long term. You're in this for the long term. Like I said, as long as you have 5 or more years to invest, you're going to be fine. Chances are the stock market's going to do really well by the time that you need the money. And also know, guys, that, like I said, when you do need the money, you're not pulling out your entire investment at one time. When you do start living off your investments, you're only living off a certain percentage. And then when you do need, and the rest of your investments stay in the stock market. So your investments continue to grow. Like I said, my partner's father, he retired with, I think it was like $250,000 of a portfolio. And to this date, his money has earned more in the stock market. He has more now than when he did when he retired. So just know that even if you don't have as long as somebody who's 23 years old, you don't pull out everything at one time. You're in this for the long term. And all you have to do anytime that you're feeling like you're losing money, just know that the stock market has always recovered from everything. The U.S. economy has always recovered. And if it doesn't recover, guys, then we have more problems than the money that we have invested in the stock market. And then the final thing, guys, is to take care of yourself. Focus on self-care. Make sure that you're spending time taking care of your health. Make sure that you're exercising, taking care of yourself through diet, sleeping well. And all this stuff is going to help you with your health, because if you're constantly worried about the stress, the money that you're supposedly losing, even though we all know that you don't lose until you sell, it can have a negative effect on you. And we all know that stress is horrible for the body. And if you allow the stock market to affect your health, then you're going to suffer from relationship problems. You're going to suffer from health problems, and you're going to suffer from lack of sleep. So all these can have negative impacts on your health. And I've said it several times again, and I'll say it again, guys. It doesn't matter how much wealth you have if you don't have your health. Health is the most important part of your life. If you don't have your health, it doesn't matter how much wealth you have. So take care of yourself. Make sure that you're exercising on a regular basis. Make sure you're taking care of yourself and eating the right foods, avoiding sugars, and make sure that you're sleeping properly. All this can be accomplished on taking your mind off the stock market. It's going to do what it's going to do. There's nothing you can there's nothing you can do. Don't look at it every day if it affects you, and just keep doing the same thing that you're doing. Don't change your investment strategies. Leave your stocks alone as long as you know that everything that you're invested in is the right investment for you. As long as you're not invested in individual stocks, if you don't have all your money in individual stocks and you're investing in index funds and ETFs, chances are you're going to come out of this smelling like a rose, as long as you keep contributing on a regular basis and don't worry about what the stock market's doing. So anyway, guys, I just wanted to share these tips with you on how to invest and handle your emotions during a volatile stock market, because we all know that psychology is a huge part of investment. If you feel like you're going to lose money, if you look at your stock market, if you look at your stock portfolio on a regular basis, you're going to be tempted to panic sell because your emotions are going to get the best of you. So emotions is a huge part of investing, and you have to learn how to control your emotions. So anyway, guys, let me know down in the comments below, are you feeling emotional now that the stock market has been taking a volatile, has been so volatile in the last couple of weeks? What are you doing differently, if you're doing differently, and how are you handling those emotional feelings that you're having, if you're having any? Let me know down in the comments below, guys. maybe you can help those who are suffering from dealing with the emotions now that the stock market is just so unpredictable now. Every day it's different. It's either red, it's green. We don't know what it's doing. Anything that you can add to the comment section can help us ensure that we don't panic sell and take a loss when we don't need to take a loss. And if you enjoyed this video, guys, give it a thumbs up. Click on that subscribe button so that you can be notified whenever I put out a new video. And until next time, guys, I will talk to you later. Have a great day. Bye.